Jordan opened his paycheck on a Tuesday morning in March and sat very still for about 30 seconds. He had just received the raise he'd been working toward for 2 years. His manager had called it a strong increase. Human Resources had described it as reflecting his exceptional contributions. His colleagues had congratulated him in the hallway. He'd told his wife that things were finally going to feel different. He'd done the math in his head on the drive home the night the offer was confirmed. The number looked like breathing room, like the edge of something better. The raise was $11,000 per year. The first paycheck after the raise showed an increase of $201. He read it again. He checked the date to make sure he was looking at the right stub. He wasn't misreading a decimal point. $201 per paycheck. His $11,000 annual raise, the raise that was supposed to change things, had arrived as $201 every 2 weeks before he'd spent a single dollar of it. He sat in his car in the parking garage for a few minutes before going into the office. He never told his wife the actual number. Now let me tell you about someone else. Camille received a raise of $9,000 the same year. Smaller than Jordan's. Her colleagues, if they'd known, might have felt slightly sorry for her. But Camille had spent 45 minutes with a tax calculator and a notepad before she ever received the offer. She knew exactly what the raise would produce after taxes. She had already decided where every dollar of the after-tax increase was going before it arrived. She redirected $300 per month of it directly into her HSA and retirement account, which reduced her taxable income and recovered a portion of what the tax code had taken. Her effective financial improvement from a $9,000 raise was, in practical terms, larger than Jordan's improvement from an $11,000 one. She got less. She kept more. And Jordan, sitting in that parking garage, had no framework for understanding how any of that was possible. Pause. Music fades in softly. This isn't about how unfair taxes are. It's about the gap between what you think a raise is worth and what it is actually worth, and the specific, learnable strategies that determine which side of that gap you end up on. Because the tax code is not a flat wall that takes a fixed percentage of everything you earn and leaves the rest alone. It is a layered, complicated, surprisingly navigable system that rewards people who understand it and quietly punishes people who don't. And the vast majority of working people, people who are earning well, trying hard, doing everything they were told to do, are being punished by a system they've never been taught to read. I'm going to show you the real rules of how taxes interact with your income, what actually happens when you get a raise, why the number on your offer letter bears so little resemblance to the number on your paycheck, what the tax code is quietly taking from you that it doesn't have to take, and exactly how people at every income level are legally, consistently recovering money that most workers simply leave behind. These aren't loopholes for the wealthy. They're standard features of the tax code that exist specifically for people like you, and most people never use them. Transition to core content. Rule 1. Your raise was never the number on the offer letter. It was always a smaller number, and not knowing the difference is the first and most common tax mistake working people make. This isn't a complaint about taxes. It's a statement about math literacy. When your employer says they're giving you an $11,000 raise, that number is a gross figure. It is the amount by which your pre-tax compensation is increasing. Your actual take-home increase is that number minus federal income tax, minus state income tax if your state has one, minus Social Security and Medicare contributions. Each of those reductions is calculated on the marginal dollars of your new income, the additional money above what you were already earning. Here is the math for a single filer in a state with a 5% income tax, earning somewhere around $75,000 before the raise. The $11,000 raise falls primarily in the 22% federal bracket. State tax adds 5%. FICA adds 7.65%. Combined marginal rate, approximately 34.65%. Your $11,000 raise, after taxes, produces roughly $7,180 in additional annual take-home. Divided across 26 biweekly paychecks, that's $276 per paycheck, not $201, but the exact number depends on your withholding elections, your deductions, and several other variables most people have never examined. The hidden consequence is not just disappointment. It's that when people build expectations around the gross raise and then experience the net raise, they feel cheated by a process they don't understand. That feeling of being cheated without the knowledge to do anything about it creates a passive resignation toward taxes that is expensive to maintain. The psychological insight is that a number you were told without context becomes the emotional anchor. The $11,000 is what you told your spouse. It's what you calculated against in your head. It's the real number to you. The actual take-home feels like something was stolen, rather than understanding that the gross figure was never a meaningful measure of your actual improvement. Understanding this in advance doesn't change the taxes, but it changes your ability to plan around reality rather than fantasy. Rule 2. The marginal tax rate and the effective tax rate are two entirely different things, and confusing them leads people to make genuinely costly decisions. This is one of the most persistent and damaging misconceptions in personal finance, and it affects decisions far beyond just how people feel about their paychecks. The marginal rate is the rate applied to your next dollar of income. The effective rate is the average rate you actually pay across your entire income. These are not the same number. They're often not even close. Here is how that actually works. The United States federal tax system is progressive and structured in brackets. The first approximately $11,600 of your taxable income is taxed at 10%. The next portion up to about $47,150 is taxed at 12%. The next portion up to about $100,525 is taxed at 22%. And so on. When people say they're in the 22% bracket, they don't mean 22% of everything they earn goes to federal taxes. They mean 22% of the portion of their income that falls within that bracket. A single filer earning $80,000 with the standard deduction has a taxable income of roughly $66,500. Their effective federal tax rate is somewhere around 15 to 16%, not 22%. But because they know their bracket is 22%, many people believe they are paying 22% of everything. Some people believe this so firmly that it influences their decision about whether to take on additional work, freelance income, or a second job. They decline opportunities because they believe the government will take 22 cents of every new dollar, when the reality is more nuanced and the opportunity cost of that misunderstanding can be significant. But here's what most people miss. This confusion also distorts how people evaluate the benefit of tax deductions and pre-tax contributions. When you contribute to a traditional 401k, the tax savings on that contribution are calculated at your marginal rate, the rate applying to your highest dollars of income. This means tax-deferred contributions are more valuable than many people realize because the money you're sheltering was going to be taxed at your highest applicable rate. Rule 3. Every raise moves some of your income into a higher bracket, and if you do nothing, you lose a specific, calculable amount that you didn't have to lose. The bracket creep problem is real, quiet, and almost entirely avoidable for people who know it exists. When a raise pushes some portion of your income across a bracket threshold, from the 12% bracket into the 22% bracket, for example, that portion is now taxed at a higher rate than it was before. The raise itself triggered the increase. And if you do nothing, you simply absorb the higher taxation and move on. But here's the thing. Tax-advantaged contribution limits for your 401k, your IRA, your HSA exist specifically as mechanisms to bring taxable income back down. If a raise pushed $5,000 of your income into a higher bracket and you increase your 401k contribution by $5,000, you have, in practical terms, neutralized the bracket creep on that portion of your income. The raise goes into retirement savings instead of into a higher tax bracket. You've redirected a raise from the government to your future self. Most people don't do this because they don't know the connection exists. They receive the raise, they see the disappointing net increase, and they move on. The tax code offered them a tool. They didn't know to pick it up. The real-world example that makes this concrete. A single filer earning $89,000 receives a $5,000 raise to $94,000. Approximately $4,000 of that raise crosses the boundary from the 22% federal bracket into the next tier. By increasing their traditional 401k contribution by $4,000 per year, They bring their taxable income back to the level it was at before the raise, for tax purposes, while actually banking $4,000 more in their retirement account annually. They've converted bracket creep into forced savings. Rule 4. Your W-4 is one of the most financially important documents you've ever signed, and most people filled it out in 5 minutes during their first week of a new job and never thought about it again. The W-4 is the form you give your employer to tell them how much tax to withhold from your paycheck. And because it was handed to you during onboarding, surrounded by health insurance paperwork and parking passes and badge photographs, most people treated it as administrative noise rather than a meaningful financial decision. It isn't administrative noise. It is the document that determines how much of your money the government holds throughout the year and at what cost to you. Here is what most people don't understand about withholding. When you over-withhold, when your W-4 tells your employer to take out more federal tax than you actually owe, you are giving the government an interest-free loan. You will get it back in April in the form of a refund. And most people celebrate that refund. It feels like a gift. The average federal tax refund in recent years has been roughly $3,000. Most recipients treat it as found money. It is not found money. It is your money. Money you earned in January that the government held until April. Money that, had you withheld correctly and received it in your paycheck throughout the year, could have been invested. At even a modest return, $3,000 held for an average of 6 months has an opportunity cost. Over a lifetime of working, the compounded opportunity cost of chronic overwithholding is a number that most people would not find comfortable to calculate. It gets worse. The refund psychology is deeply counterproductive. People who receive large refunds feel flush and often spend impulsively. The money that should have been building wealth throughout the year arrives in a lump sum and gets absorbed into a vacation, a TV, a credit card balance. The government didn't save you money. It just changed the timing in a way that made it easier for you to spend. Rule 5. The tax system has a category of income that is taxed at a lower rate than your salary, and most working people don't use it at all. This is one of the clearest examples of a tax advantage that exists in plain sight and is largely unused by the people it was designed to benefit. Long-term capital gains, the profit from selling an asset you've held for more than 1 year, are taxed at a preferential rate compared to ordinary income. For most middle-income earners, the long-term capital gains rate is 15%. For earners below a certain threshold, it is 0%. For ordinary income in the 22% bracket, the rate is 22%. The difference is real and it compounds. What this means practically is that money you invest in a taxable brokerage account and hold for over a year is taxed more leniently than money you earn from work. The tax code is designed, intentionally or not, to reward people who invest consistently in long-term positions. And because most working people don't invest in taxable brokerage accounts, either because they're not aware of the advantage or because they have no surplus to invest, this benefit flows almost entirely to people who are already building wealth. But here's what most people miss. Even modest, consistent investment in a taxable account, $200 or $300 per month, in a low-cost index fund, held for years, begins to generate income that is taxed at a more favorable rate than your paycheck. Over time, as the account grows, a meaningful portion of your total income can shift from ordinary income tax rates to capital gains rates. This is not aggressive tax planning. It is the basic mechanics of how the tax code treats different types of income. The hidden consequence of not investing in a taxable account is not just lower wealth accumulation. It's that your entire income remains subject to ordinary income tax rates indefinitely. You never develop an income stream that the tax code treats preferentially. Every dollar you earn is a salary dollar, taxed accordingly. Rule 6. There is a category of account that gives you a tax deduction when you contribute, tax-free growth while the money sits, and tax-free withdrawals when you use it, and millions of eligible people have never opened one. The health savings account is the most tax-advantaged account in the United States tax code, and it is chronically underused by the working people who are most eligible for it. To be clear about what this account does, you contribute pre-tax dollars, reducing your taxable income. The money grows tax-free, like a Roth IRA. When you withdraw it for qualified medical expenses, you owe no taxes. This is a triple tax advantage that exists nowhere else in the standard tax code. In 2024, an individual with a qualifying high-deductible health plan can contribute up to $4,150 to an HSA. A family can contribute up to $8,300. For someone in the 22% federal bracket plus a 5% state tax, maxing out an individual HSA saves approximately $1,120 in taxes in that year alone. And unlike a flexible spending account, HSA funds roll over indefinitely. They don't expire. They can be invested and grown just like a brokerage account. Here is the strategy that almost nobody uses, but that changes the math significantly. Instead of withdrawing from your HSA immediately when you have a medical expense, you pay the expense out of pocket and save the receipt. You let the HSA funds grow, invested, for decades. After age 65, you can withdraw from the HSA for any purpose, not just medical expenses, and pay only ordinary income tax, making it function like a traditional IRA with the additional benefit that medical withdrawals remain tax-free. You then submit all your saved receipts and reimburse yourself tax-free, potentially decades later. The hidden consequence of ignoring the HSA is straightforward. You're paying full income tax on money that you will eventually spend on healthcare anyway. The HSA allows you to use pre-tax dollars for those expenses. Not using it means you're paying taxes on money before it goes to medical costs, an entirely unnecessary expense. Rule 7. The standard deduction is the right choice for most people, but the people who itemize correctly can recover thousands of dollars that the standard path leaves behind. Most people take the standard deduction. For many of them, it's the right call. The standard deduction for a single filer in 2024 is $14,600. For married filing jointly, it's $29,200. If your itemizable deductions don't exceed these thresholds, the standard deduction is more valuable. But the mistake isn't in taking the standard deduction when it's appropriate. The mistake is never calculating whether itemizing might be better in the years when your deductible expenses are high enough to make it worth examining. Common itemizable deductions include state and local taxes up to $10,000, mortgage interest on a primary residence, charitable contributions, and in some cases medical expenses exceeding 7.5% of your adjusted gross income. In a year when you close on a home, pay significant mortgage interest, live in a high-tax state, and donate meaningfully to charity, your itemizable deductions might easily exceed the standard deduction threshold, and most people simply don't check. The real-world scenario that illustrates this. A married couple in California earning a combined $140,000 bought a home in 2023. Their mortgage interest for the year was $18,000. Their state and local taxes hit the $10,000 cap. They donated $3,200 to charity. Their itemizable deductions total $31,200, exceeding the standard deduction by $2,000. At a combined marginal rate of roughly 27%, that additional $2,000 in deductions saves them $540 in that tax year. Not life-changing in 1 year. But if they run this calculation every year instead of defaulting to standard, they recover savings they'd otherwise miss. The psychological insight is that defaulting feels safe. It feels like you're doing what everyone does and therefore can't be wrong. But tax optimization isn't about being clever. It's about paying attention to what the code offers and using it. Rule 8. Freelance and self-employment income is taxed in a way that most people discover too late, and the discovery is usually expensive and stressful. If you have any income outside of your primary W-2 employment, freelance work, a side business, consulting, rental income, gig economy work, you are subject to a tax dynamic that most people encounter for the first time at tax filing time, in the form of an unexpectedly large bill. Here is what happens. W-2 employees have taxes withheld throughout the year. Social Security and Medicare taxes, 7.65%, are split between employer and employee. The employee pays 7.65%. The employer pays the other 7.65% on their behalf. Self-employment income receives no employer contribution. You pay both sides. The self-employment tax on the first $160,200 of net self-employment income is 15.3% before federal income tax, before state income tax. A freelancer who earns $20,000 in side income and assumes they'll pay 22% in taxes will discover at filing time that they owe significantly more. The self-employment tax alone on $20,000 is approximately $2,826. Add federal income tax at 22% on the taxable portion, add state taxes, and the total bill can approach $6,000 to $7,000 on $20,000 of income. A rate of 30 to 35% that nobody warned them about when the client sent the first check. But here's what most people miss. Self-employment comes with deductions that W-2 income doesn't. A portion of your self-employment tax itself is deductible. A home office used regularly and exclusively for business may be deductible. Business-related equipment, software, professional development, and a portion of your phone plan may be deductible. A self-employed person who keeps clean records and understands their deductions can reduce their taxable self-employment income meaningfully. Even more significantly, a self-employed person can open a solo 401k and contribute up to $66,000 per year, or a SPRA, and contribute up to 25% of their net self-employment income. These contributions directly reduce taxable income. A freelancer who earns $40,000 in self-employment income and contributes $10,000 to a SPRA has reduced their taxable self-employment income by $10,000, saving potentially $3,000 or more in taxes while simultaneously investing for retirement. Most freelancers do none of this and simply absorb the full tax bill every April. Rule 9. Your employer is offering you tax-free benefits that function as a raise, and most people ignore them because they don't appear on their paycheck. This rule is about the invisible compensation that exists in most employment arrangements and the remarkable frequency with which it goes entirely unclaimed. Many employers offer benefits that are either tax-free or tax-advantaged, meaning they deliver value to you without generating a tax liability. The most common and most valuable of these is the employer match on retirement contributions. If your employer matches 50% of your contributions up to 6% of your salary, and you earn $80,000, the employer will contribute up to $2,400 per year to your retirement account, but only if you contribute at least 6% yourself. Most employees know this exists. A surprisingly large number contribute less than the threshold required to claim the full match. Beyond the match, many employers offer commuter benefits that allow you to use pre-tax dollars for transit or parking. At current limits, this can shelter over $3,000 per year from taxation. Dependent care FSAs allow parents to use up to $5,000 in pre-tax dollars for childcare expenses, a category where the spending is happening anyway and the tax treatment simply makes it cheaper. The hidden consequence of not using these benefits is that you are effectively declining compensation. The employer match you don't claim is money left on the table. The commuter benefit you don't use means you're paying transit costs with after-tax dollars when you could be paying them with pre-tax dollars. The dependent care FSA you ignore means paying full income tax on money you're spending on childcare regardless. The total value of unclaimed employer benefits across all categories for a typical employee who isn't paying attention can easily reach $4,000 to $6,000 per year. Not in complicated planning. Not in anything requiring professional advice. Just in reading the benefits enrollment materials carefully and making the elections that are available to every employee. Rule 10. Tax loss harvesting is a strategy most people have never heard of, and it quietly saves disciplined investors hundreds to thousands of dollars every year. This is one of the rules that makes people feel like it must be for wealthy investors. It isn't. It's available to anyone with a taxable brokerage account, and it works consistently for people who understand its mechanics. Here is the concept. In a taxable brokerage account, when you sell an investment at a loss, that loss can be used to offset capital gains elsewhere in your portfolio. If your gains exceed your losses, up to $3,000 of net losses can be deducted against ordinary income per year. Remaining losses carry forward to future years. The practical application during a market downturn. In 2022, most broad market index funds declined significantly. An investor holding a total stock market index fund that had declined in value could sell it, immediately buy a similar but not identical fund, say a large cap index fund, and capture the paper loss for tax purposes while remaining fully invested in the market. The IRS has a wash sale rule that prevents you from buying back the identical security within 30 days, but buying a different fund that tracks a similar index is permissible. The result is that the investor remains invested in stocks, avoids any meaningful gap in market exposure, and generates a tax loss that offsets current or future gains. Done consistently in years when positions are down, this strategy can recover hundreds to several $1,000s in taxes annually for a disciplined investor. I'm not done yet. The cumulative effect of annual tax loss harvesting over a decade of investing is not just the annual tax savings. It is the compounding of those savings reinvested. The investor who harvests losses annually and reinvests the tax savings year after year builds meaningfully more than the investor with identical gross returns who ignores this strategy entirely. Rule 11. The Roth versus traditional contribution decision is worth more money than most people realize, and most people make it by accident rather than by calculation. Nearly every workplace retirement plan offers both a traditional pre-tax option and a Roth after-tax option. Most people pick one at enrollment and never revisit the decision, often based on vague advice they half remember or a default their plan selected for them. The decision deserves more attention than that because it is, in effect, a bet on your future tax rate relative to your current tax rate. Traditional contributions reduce your taxable income today, at your current marginal rate, and the money grows tax-deferred. You pay ordinary income tax when you withdraw in retirement. If your tax rate in retirement is lower than your current marginal rate, traditional wins. Roth contributions offer no current year deduction. The money grows tax-free and withdrawals in retirement are tax-free. If your tax rate in retirement is equal to or higher than your current rate, Roth wins. Here is the calculation that most people never run. A 30-year-old in the 22% federal bracket, contributing to a Roth, pays 22% tax now and nothing later. If they retire into a 22% bracket, the outcome is identical to traditional. If they retire into a lower bracket because their income is lower, or because tax rates change, or because they've reduced their spending, they overpaid. If they retire into a higher bracket, Roth was the right call. The specific insight that changes this calculation. Roth accounts have no required minimum distributions during the account owner's lifetime. Traditional accounts require you to begin withdrawing, and therefore begin paying taxes, at age 73 regardless of whether you need the money. For people who are likely to have substantial retirement savings and who don't anticipate needing large distributions, the Roth's RMD advantage alone can be worth significant tax savings, entirely separate from the rate comparison. Rule 12. Nobody talks about the tax bracket impact of two-income households, and it quietly increases the tax burden for millions of married couples in ways they never anticipated. This is the marriage penalty, and while it has been partially addressed by tax legislation over the years, it still exists in specific and meaningful ways for certain income combinations. When two earners marry and file jointly, their combined income is taxed on a joint bracket schedule. In an ideal scenario, the joint brackets are exactly twice the single filer brackets, and there is no penalty. For much of the income range, this is approximately true. But at certain income combinations, the interaction produces a higher total tax liability than two single filers with the same combined income would pay. The more common and less discussed issue is the effect on marginal rates. A single filer earning $50,000 is in the 22% bracket on a relatively small portion of their income. When they marry a partner also earning $50,000, the $100,000 joint income is subject to slightly different bracket dynamics. But more importantly, if one spouse receives a raise or bonus, that income is added on top of the combined household income, potentially pushing it into a higher bracket than it would reach if either person were filing alone. The practical implication is that households where both partners earn should run their tax projections together, not separately. The decision about when to take a bonus, whether to pursue a freelance opportunity, how much to withhold, and which deductions to prioritize should be made with the full household tax picture in view. Most couples don't do this. They manage their income somewhat separately and discover the combined effect only when they file. Rule 13. Qualified retirement accounts don't just defer taxes. They change the math of every investment return you earn inside them in a way that most people never fully internalize. This rule is about understanding what tax deferral actually does to the compounding math, because when you see it calculated directly, it changes how urgently you use every available contribution limit. Outside of a tax-advantaged account, every dividend you receive, every capital gains distribution your fund makes, is a taxable event. You owe taxes on that income in the year it occurs, even if you reinvested it. Over decades of investing, the drag of annual taxation on investment income is meaningful. Your compounding engine is running, but a portion of the fuel is being diverted to taxes every year. Inside a traditional 401k or IRA, none of that happens. Dividends, capital gains, interest, all of it reinvests without a current tax event. The entire balance compounds without interruption until you withdraw. The tax is deferred to retirement, where two things may work in your favor. You may be in a lower bracket, and you've had decades of uninterrupted compounding that wouldn't have occurred in a taxable account. Here is the math made concrete. Two investors each start with $10,000 and earn identical 7% gross annual returns. One invests in a taxable account and pays 15% in taxes on annual gains each year. One invests in a tax-deferred account and pays nothing annually, then pays 20% in taxes at withdrawal after 30 years. After 30 years, the taxable investor has approximately $54,000. The tax-deferred investor withdraws approximately $76,000 after paying their deferred tax bill. The tax-deferred investor ends up with 40% more despite technically paying a higher tax rate, simply because the compounding ran uninterrupted. The hidden consequence of leaving tax-advantaged space unused is not just the current year tax savings you're foregoing. It's the decades of compounding drag on investments that should have been inside the shelter. Rule 14. Your tax situation is not static, and treating it as if it is costs people money at every major life transition. Marriage, divorce, a child, buying a home, a job change, a side business, inheritance. Each of these events changes your tax situation in specific, significant, and often underappreciated ways. And most people respond to these events by updating their life, but not updating their tax strategy. The birth of a child is a clear example. The child tax credit, the dependent care FSA, the possibility of adding a dependent to your return, these are tax changes that take effect the year the child is born, not later. A parent who doesn't update their W for withholding and doesn't set up a dependent care FSA in the year of their child's birth is overpaying taxes on money they could have sheltered in an account specifically designed for childcare expenses. Buying a home creates potential mortgage interest and property tax deductions that may push you from the standard deduction to itemizing, but only if you run the calculation that year and make the adjustment. A job change where one employer's 401k is left behind creates the question of whether to roll it into an IRA or a new employer's plan, a decision with real tax and investment implications that most people handle hastily or not at all, leaving the old account to sit unmanaged. The rule is simple even if applying it requires effort. Every major life event should trigger a specific review of your tax picture. Not a general sense that things have changed. An actual calculation of what changed and what elections or strategies should change with it. Rule 15. The single most recoverable tax mistake most people make costs them nothing to fix, and almost nobody fixes it. The most recoverable mistake is simply not reviewing your tax return from last year before making decisions this year. Your prior year's tax return is a document that tells you exactly what happened to your income in the previous 12 months, what you paid, what you could have sheltered, what credits you qualified for but didn't take, what deductions you missed, and what your effective rate actually was. Most people file their return, feel relief that it's over, and put the document away without reading it carefully. If you read last year's return with a specific set of questions, did I max my available tax-advantaged accounts? Did I claim every credit I qualified for? Was my withholding accurate? Did I pay self-employment tax that retirement contributions could have reduced? You will almost always find at least one recoverable item. Something you could do differently this year that will reduce your tax bill without reducing your income. This is not complicated tax planning. It does not require a CPA, though a good CPA can accelerate the process significantly. It requires 45 minutes and the willingness to look at numbers that most people find uncomfortable. Transition to closing. Let me take you back to Jordan, sitting in that parking garage. $201 per paycheck. $11,000 raise. The math felt like a betrayal. And in one sense, nothing about what Jordan experienced was wrong or unusual. The tax system did exactly what it was designed to do. His marginal dollars were taxed at his marginal rate. The withholding worked as it was set up to work. What Jordan didn't know, what nobody had ever sat down and explained to him, is that the $201 was not a ceiling. It was a starting point for a different kind of calculation. The $11,000 raise had created new tax advantage space he wasn't using. It had pushed some of his income into a bracket that pre-tax contributions could bring back down. It had arrived at a moment when he could have redesigned his withholding, increased his retirement contribution, and redirected a significant portion of what the tax code was taking back into his own long-term financial position. He didn't know to do any of that. So he sat in the parking garage, felt the quiet deflation of an expectation not met, and went back to work. Camille, with her smaller raise, left that same moment with a different feeling, not because her taxes were lower or the system treated her differently. Because she'd done 45 minutes of math before the raise arrived. She knew what the number actually meant. She knew what the code was offering her. She used it. The tax code is long and genuinely complicated in its extremities. But the rules that affect most working people, the brackets, the accounts, the deductions, the credits, the withholding mechanics, are learnable. They don't require a law degree or a wealth manager. They require the decision to understand the system you're operating inside, rather than simply receiving whatever it produces by default. Because here's the thing about defaults. The tax code's default is designed to collect what you owe. It is not designed to minimize what you owe. That work is left to you. And most people never do it. Not because they're irresponsible, but because nobody taught them that there was work to be done. Jordan's $201 could have been more. Not a little more. Meaningfully more, redirected strategically into accounts that compound quietly toward a future he can't see yet. The raise is already in your paycheck. The question is how much of it actually belongs to you. Go find out.